Hey everybody, it's Daniel here from Infovest. Hope you're all doing well. So I got an interesting article here for you, and actually this news came out last night. There was a headline from Bloomberg reporting about China. Now, what I'm going to talk about in this article is very interesting, not only for the Chinese market, but most importantly the US market, the North American markets, and other markets out there, right? So I'll leave this article in the description so you could read up and you can follow along if you like. Again, it comes out from Bloomberg. And the title is China's Bold Stock Market Rescue Plan Leaves Investors Skeptical. All right, very important here, very important headline. I'm going to break it down, what happened last night, what's going on today, and you know, what this could mean for especially the U.S. stock market. Now, let's first get into the article. It starts off by saying China's boldest plan yet to stem the current stock market rout is facing a wall of skepticism, as disillusioned investors say any rebound will prove fleeting without fundamental fix for its ailing economy. A rare mix of positive news, including a stabilization fund in the works and Premier Li ordered to calm markets, sent equity benchmarks rallying on Tuesday. However, China's history of botched market rescue efforts, the grim state of its economy, and uncertainties over Beijing's long-term policy roadmap are keeping investors skeptical about sustainability of these gains. Should the rally fail to hold, it raised the risk of further downward spiral in sentiment, something authorities can ill afford given that investors are already reeling from a record 3-year losing run in onshore equities and markets heft in global portfolios is shrinking rapidly. Okay, so what does this all mean? Confusing 3 paragraphs. Let me break it down here, okay? Last night, right, yesterday night, we got headlines, we got news that China's looking to give some sort of rescue money for its markets, for the stock market, for its economy, and so on, okay? They're pumping money in. They're pumping or thinking about pumping liquidity money into the system. Why? Well, since 2021, right, if you look at the China Golden Dragon Index, that has dropped since 2021 till now about 70+%. The Hang Seng also, about a year, has dropped about 30%. China's been under a lot of pressure, especially since Trump's time, with all the trade war that's happened, the more uncertainty, animosity between the US and China, more pressures, more pain in terms of trade, and not much of agreeableness between these two big powerhouse countries, US and China, right? And China's been also affected since COVID. A lot of people were saying that, you know, COVID's out of the woods, and when COVID's out of the woods, China would be the powerhouse. They're going to be the country that's going to bring the whole world up higher, the economy higher, and so on. And that has yet to be true. That hasn't happened. In complete reverse, China's actually getting worse. They have a property problem there as well, where a lot of their builders went belly up, and a lot of investors and individual investors and citizens that bought properties are underwater and have lost a lot of money. And not only their real estate market, but their tech stocks, their stock market as a whole, their economy as a whole, it's not growing that rapidly and not doing that well, and a lot of losses across the board, right? So China's been under a lot of pressure. So with this, the politics, geopolitics, with the stock market, the real estate and whatnot, China yesterday decided to come out with this rescue plan, this package. Now, what's this rescue plan? What's this package? I'll go over it here in this next paragraph. The latest package, including about 2 trillion yuan, which is about 278 billion, to buy mainland shares via offshore trading links, shows a sense of urgency from authorities. It comes after a rout that seen Chinese and Hong Kong stocks erase more than $6 trillion in market value since the peak reached in 2021. The value of China's equity market has never been this far behind that of the US. So, like I said, since 2021, right, China's equity markets have been under a lot of pressure. They're coming with a package of 2 trillion yuan to pump into the equity markets to try to make things better. What happened when that headline came out last night? We saw a pop in the Chinese equity markets. The Hang Seng basically rose about 2.8% on Tuesday, right? And we also saw the Nasdaq Golden Dragon China Index rallied as much as 6.3%. So quite the optimism there. We also saw a jump in Alibaba, more than 8%. This was on report of founder Jack Ma has been buying up shares in the firm. So they're trying to create this optimism, right? China, you hear CEOs coming back, don't worry, buy Chinese stocks, buy Chinese stocks. And yeah, a lot of them have been hammered, right? When you look at the tech companies in China, especially the Golden Dragon Index, down 72%, 70 plus percent. You know, you start to think, okay, eventually, where's this bottom? Eventually, things should pick back up, especially if you're going to get some stimulus from the government, from certain CEOs, and so on. Now, here's the thing, right? Here's the thing. There's a lot of skeptical people out there. There's a lot of uncertainty still in China. And even with this pump of money, this injection, it still may not be enough. Remember, like it mentioned here in this article, Hong Kong stocks erased more than $6 trillion in market value, right? So the 2 trillion in yuan, which is 278 billion, is a very small little drop in the bucket. They've got to pump more. They got to do more to save and help the economy. And let's not forget, there's also other pieces, like other countries out there that are yet to face certain issues, certain problems with their own economy, which will also trickle into China and many other countries globally, right? Not only China's economy and their demand issue and their problems will also trickle into other countries, as we're all interdependent on trade and each other, right? But we have yet to see more pain to come. This is just the beginning of many things to come. And now, when you look at how the markets are trading, especially the equity markets, you've seen quite a little bit of a pullback. And even though they're looking or thinking to be pumping some money into the markets and into the economy and providing some sort of liquidity, it doesn't necessarily mean that this is the bottom and things are going to turn around. Because if you look back at past examples, like for example in 2015 in China, another very good example where the stock market was declining in 2015. And in 2015, as the stock market was dropping, China decided that, hey, we're going to pump in some money again. So China Securities Finance Corp spent around 1.5 trillion yuan buying stocks. They said, okay, let's go out and let's pump, stocks higher again in 2015 after the Shanghai Composite dropped. And what happened after that when that money came in, pumping into stocks, you had a little bit of sideways action, then sell off again, then a little bit of a move up, and then boom, a sell off again. And that's when also circuit breaker was introduced. And that happened a year after another sell off in the Shanghai Composite, right? So don't think, although pumping of money, injecting liquidity is a good thing, it doesn't necessarily mean that's going to be reactive right away in the equity markets. Doesn't necessarily mean it's going to fix things right away. You might think of COVID 2020 when they did inject money into the markets, especially in the US, many of the central banks out there, and we saw a nice V-shaped reversal. That's because they pumped a lot more money than what the whole market value and the equity markets out there lost. So, but with that fast amount of money printing and that pumping that was injected into the markets, that doesn't necessarily mean that future central banks are going to do that, aka like for example the US and so on, right? So even though if they talk about printing money or pumping money or QE, quantitative easing, right, doesn't necessarily mean that the stock market is going to bounce all of a sudden. It really depends on when it's being started, how long it will this program take for really its true effects to show into the economy, into the market, how much is being pumped into the market as well. Are we pumping, a small amount? Are we pumping a large amount? Is that going towards, the economy and stocks and so on? How much of it, etc., etc.? How long do they take? These are all questions to think about when it comes to the QE, the pumping money is saving the equity markets. So this has a lot to relate to the US markets, because what we're hearing right now is we're hearing about rate cuts coming soon. And then what happens after rate cut cycle, or while we begin the rate cut cycle? People are going to start talking about and thinking about QE, quantitative easing, and so on. So when that comes, or if it comes, right, how much will it be? When will it be? Will it be too long? Will the central bank, the Fed, take too long to deliver, its promises or do some sort of QE, right? What will that look like? And just because they start cutting rates and maybe pump a little bit money, don't think that that's going to be stocks to the moon, unless they do something just like COVID and they pump way more than what's expected and pump way more than what was pumped in history. Then sure, you might see that nice quick reversal. But if they don't, and if they start to cut rates, don't think that's right there, the bottom, and things are just going to jump up high just like COVID. That's not very much true. Not necessarily true. And 2008 is a very good example. When things came down, they did the emergency cuts, they did rate cuts, but the market started to go down, right? Still continued to sell off. The stock market sold off. Same thing here, the example I gave you for the Shanghai Composite in 2015, right? It was selling off. They decided to pump some money into the markets, and it still continued to sell off. So this idea that rate cuts and printing of money is going to solve everything right away, real estate's going to go to the moon, stock's going to go to the moon, whatever asset you're thinking about is going to go to the moon, not necessarily true, right? Although yes, medium, long term, yes, it does come back up, but the initial reaction and what's happening during that time is the reason they're doing that, the pumping of money, the cutting rates, is because, very simple, shit is hitting the fan. Things are getting worse off. They need to create demand again, the optimism, get people buying again, because, again, shit's getting worse. So, very good example. This article is a very good example. This headline that came out from China is a very good example. And the 2015 idea that I gave is also another good example. 2008 example that I gave, very good example of how, printing of money, rate cuts may not necessarily mean stocks to the moon right away. In fact, it may mean you might get a little bit of a pump followed by panic sell, right? So I think this similar framework we could see coming in the US for North American markets, where you might start to hear rate cuts, people start to be happy, you're going to get a lot of people push out that real estate's going to go to the moon, stock's going to go to the moon, everything's going to go to the moon, right? And you might get a little bit of that consolidation or a rally, and then while everyone's chasing, then you get the big maybe black swan event, and then the panic sell, even though they're cutting rates and maybe talking about pumping liquidity money in. And when things get really worse off, then I believe that's when the central banks will step in and throw in and shoot the bazooka with as much powder to the markets, as much liquidity to the markets, to the economy, and so on. And then that's when I think they will do their best to stop the panic selling if it comes, right? And again, it can take time. It's not going to be right away. You know, like we just saw, there's a little blip of optimism and then maybe some, you know, panic selling afterwards. Okay, so I'll leave it off there. You can read the link, read the article. The link is in the description, so you could check up on that. Again, it comes from Bloomberg.com. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, bye.